I know you've been doing a lot of research recently, or you told me you were, on DCA versus lump sum buying. What are your thoughts on that?
Yeah, dude. Well, so, one of our flagship products is our Bitcoin savings plans. And it's something I use. Like I just buy it. I buy every day. And I like the peace of mind. I don't like to think about it. But we get a lot of questions from clients. We got a lot of them like sitting on the sidelines, waiting for dips. And they like to smash buy. Some like to set up Bitcoin savings plans. Some like to do a little bit of both. So we had a new CIO come on, Rafa, and he kind of ran this model, and I worked with him, and we were kind of digging into what's actually the better strategy historically. Is it lump sum or DCA, and why might that be? And the results kind of surprised us because lump sum over the last 5 years outperformed DCA 51% of the time. And I think that was kind of like, oh, that's interesting, because I kind of always thought DCA might. And then it comes down to why that is. And the reason being is because if you look at Bitcoin's price history, it has these like really kind of like short, explosive movements upwards. And if you're on the sideline and you miss those, then, you're kind of shit out of luck. And so with DCA, I mean, you're not really like timing the market, but you are kind of timing the market, because if you have extra cash, and you're sitting on the sideline not deploying it, then you could potentially miss some of these huge days compared to somebody who just lump summed all in. And so a lot of people DCA too who just like earn as they go, and they don't have extra like money, so that's a little different. But if you have a like amount of money like 10,000 and you choose to lump sum 5,000 and then slowly DCA the other 5,000, you are kind of timing the market. You're expecting it to go sideways or maybe down to lower your cost basis. And so if you look at like here, wait, let me see if I could. So okay, here. So if you look at like the 15 largest 3-day periods from 2018 to 2023. So just in Bitcoin's price history, the 15 largest 3-day periods, the total return, if you miss those 15 3-day periods, the total return was minus 81% in a time period where the total return of Bitcoin increased 185%. So over the last like 1,800 days, if an investor was caught on the sideline for like 2.46% of those days, they ended up losing money on Bitcoin at a time period where it tripled in value. So like you cannot miss those days. And so I think it like speaks to holding, because like you and me probably have like held for a while, and it is kind of a hard thing to do. Like it's like a very like it's sideways for a lot of the time, and it's chopping. But you kind of feel it because there are these like huge days. And there's a saying in Wall Street where, stocks are staircases on the way up and, elevators on the way down, escalators. It's almost like the opposite in Bitcoin, where there's like, it's just kind of stairs down and then it shoots up, and then stairs down, shoots up. And so that's kind of what I felt too. And the data kind of confirms that. But there's an important point here. And even though lump sum, technically outperforms, you have to think about the mental kind of stress of having your entire life savings like YOLO'd in essentially, and then the volatility of Bitcoin. Like can't because the only strategy that matters is one that allows you to hold long term. And so when you look at the average drawdowns for each strategy or the max drawdowns, if you're a lump sum, you might have had to watch your net worth on paper go down 80%. Like, can you hold through that volatility? Compared to somebody who has a DCA plan. I think DCA plans have a peace of mind to it and prevent emotional decision making and prevents like panic selling essentially better than a lump sum strategy. So everyone has to just be comfortable with their own risk tolerance and see what strategy works for them, and what makes them sleep at night essentially. That's the important thing, because the only important thing is to hold long term. But it was interesting just to see those stats and see that lump sum is technically outperformed because of those like explosive days upwards.
Yeah, I mean, Bitcoin is extremely volatile, right? It goes through these massive adoption cycles where everyone wants to buy more, and then it goes through these tough, strenuous bear markets where everyone's like panic selling at the bottom. And so, yeah, I think you made a great point where you need to figure out your risk tolerance. You need to figure out like, do you understand Bitcoin? How well do you understand it? If it falls 80%, are you going to like be scared to add more? Are you going to be selling some, or are you going to be like, have a good proportion of your portfolio allocated, but not too much to where you're like kind of stressing out and worried, like, hey, like, is this a good spot for me to be in? Because in reality, you need to be stacking when the price is down 80%. So I think he made some great points there. We definitely think about it very similar way with mining at Blockware, right? I mean, mining, you basically buy a mining rig, you DCA after you buy the mining rig. It's kind of like the lump sum, and then you DCA after that with your future cash flows. So yeah, I think it's a great point, and a lot of like synergies between those two ideas, I would say.
Yeah, totally. Actually. Yeah, that's a good point.